People. Today we are on what frequency? Today we're doing 963 HZ, and what am I going to do here? I'm going to read Chapter 1, Section 3, Portfolio Basics. I'm going to lower the volume a little bit. Just so I can listen, but still, be in the game somewhat, multitask a little bit, keep your brain fresh. So section 3 is portfolio basics, portfolio construction. The types of equity securities that can be included in a portfolio include blue chip, which are the highest quality companies with proven earnings and dividend records. These are mainly large capitalization New York Stock Exchange and NASDAQ listed issues. Growth, high PE ratio companies are companies that are in a period of above average growth due to rapid market expansion or unique products. Growth companies normally do not have a proven track record and have very low dividend payout ratios. They also tend to sell at higher PEs, price to earnings multiples, than mature companies such as blue chips because of their exponential growth potential. Emerging growth. These are brand new ventures of high risk but also high potential reward. These companies have no track record and typically can't afford to pay dividends. All right, we got a team. Nice. So emerging growth, I'm assuming this is like startups. I mean, it's exactly what the name entails, right? They're emerging. It's emerging and there's a lot of potential there, but that's all it is, potential. No promise what could happen, but it's a big risk. All right, mark something in 3, 2, 1. You better do it now. All right. A team that sticks together wins together, huh? It's a Sunday afternoon. Spent time with the family. Ate a little bit. Light snack. It's good, man. It's good. Got to learn how to enjoy it a little bit and study at the same time because life is going to move quickly. So let's get a good starting loadout. I like the back bling. I just got it. It's sick, right? Now it matches. All right, homie. I need you to fall a little faster. This is not fast enough. Okay, so there is just nothing. Oh, wait. I'm right. They're wrong. No. There we go. Almost bought 2. All right, so this is gosh, I don't have. So it's still bright out, right? So it's hard to see my screen and any potential targets. My screen's got that glare. You know that glare when the sun's in your eye? You can't notice like little particles, but you can notice like the map itself. So if it looks like I should be shooting someone who's obviously in front of me, let me know. Where the hell is this thing? All right, we are just a bunch of bots in here, aren't we? Oh, this is not gonna end well. Oh, geez, someone's on me. if these are just bots, then this is fine. As long as he's not getting shot by a real player. The problem is that the lines are usually blurred here. Oh shoot, I don't have any cover. Don't have any cover for this. You're lying, you're effing lying. Oh. Yeah, I didn't really have another move. I mean, was what it was, you know? I like that card play. And honestly, I feel like I was the only one doing anything. That's just my opinion. Let's continue. Income. Mature companies with high dividend payout ratios, such as utilities. Cyclical. Companies whose fortunes track the business cycle closely. An example of a cyclical stock is a durable goods manufacturer. When the business cycle turns down, people feel poorer and don't buy washing machines or cars. Countercyclical. Companies whose fortunes operate in reverse to the business cycle. There are a very few countercyclical stocks. An example is a basic food producer such as a grain company. When people feel poorer and they don't eat out as much, so in-home cooking increases. Another classic counter-cyclical stock is a gold mining stock. When the economic cycle turns down and corporate profits erode, investors sell industrial stocks and flee to safety, that is, to gold stocks. Defensive. Companies which remain unaffected during business cycle downturns. Drug companies are a classic defensive stock, at least until recently, as are public utilities. Speculative. Companies that fly high during business cycle upturns. Toy companies and airplane manufacturers go through feast and famine periods that mirror the business cycle and are speculative. Okay. What are we marking? What are we doing? Doing that? You read my mind. Unfortunately, I left all my gold in the last game. Shouldn't have spent it all. You live and you learn. Fortnite. I'm not sure this risk is gonna pay off. It might. Let me know if you guys got any, yeah, that's gonna help me. The hell are you pinging? I don't have anything. So, no weapon at all. I'm going to blue. All right, not a bad start, not a bad start. Y'all see something, say something. I can't see anything. I can't see anything. I'm gonna close my blinds. Alright, now I can see my screen. Now I can see my screen. Oh, we were in the woods that whole time? Thought we were in the middle of the buildings. Can he pull off the clutch? This is how you know if you have a good team or not. Can they pull off the 3-for-1 trade-off? 3 cards to go, 3 cards to reboot, and we'll see what happens. Alright, 10 out of 10. Good spin. I wonder if this guy invests. Oh, he doesn't invest his money. He doesn't invest. He doesn't invest. He does not invest. Straight ahead, kid, yep. Oh, no. A company going through a takeover, restructuring, bankruptcy, or management change that will greatly change the nature of its operations, hence its earnings potential, which is called a special situation. When constructing a portfolio, the investor can take either a top-down approach or a bottom-up approach. In a top-down approach, the investor starts from the big picture and then goes into greater and greater levels of detail to determine the appropriate investments. For example, the investor would first look at overall economic conditions and trends to identify those industries that are likely to perform better than average. Then the investor would look for the specific companies in those industries that are likely to perform better than their peer group. This is not the place to land. Like, where? I feel like landing in the middle of the map. I mean, this is kind of edgy, right? It's on the edge. But oh, the other two left. They didn't. Oh no, this was a good teammate. They didn't trust him. They just didn't trust him. Wow. That stinks, man. Sorry about that. Hopefully I can lock it in now. Again, apologies. I could not see my monitor from the start. If he pulls this off, I don't know what to do, but I'm going to try my best to just live longer. Something here, but it ain't much. They really have to be positioned very well to survive a gunfight here. Hoping. Shoot. Thanks, y'all. Appreciate. Let's go ahead and, no, don't even play that. Don't play that. Let's get up on this hill. No. You want that? We can chase that, if that's what you want. Be careful what you wish for, man. I don't got much. Oh, what the? Do we die here? Wait. I see him. Gotta reposition this. Whoa. No way. Oh, behind two. Tried my best, teammate. Tried my best here. Oh, that was rough. Yeah, that's how the cookie crumbles sometimes, you know? Teammates leave before they can make the hero play. And he was going to do it, too. He was going to do it. He would have gotten us all up at the same time. Just bad logistics. Okay. In a top-down approach, the investor starts from the big picture and then goes into greater and greater levels of detail to determine the appropriate investments. For example, the investor would first look at overall economic conditions and trends to identify those industries that are likely to perform better than average. Then the investor would look for the specific companies in those industries that are likely to perform better than their peer group. The bottom-up approach to investing is the exact opposite. The idea here is that the investor looks at specific companies first, choosing the best ones, say based on new products coming to market, etc. These companies should do well regardless of overall economic conditions or trends. Portfolio returns. Return on investment is a classic measure of performance. It looks at positive cash flows that are generated from a given dollar investment and shows them as a percentage return. For example, assume that an investor of $10,000 is made with a 5-year life. Assume that an investment of $10,000 is made with a 5-year life and returns $1,000 per year for 5 years, at which point the $10,000 principal is returned. The return on investment is 10%, right? $1,000 a year for $10,000 for 5 years. Yeah, 10% a year. Basic mathematics. All right, I got my headphones off here because the noise, it's not the noise of the vibration, it's the noise of the game that's kind of pissing me off. I hate the doo-doo, doo-doo, doo-doo. Like, I don't care. I don't care about the doo-doos, right? Here, let me, no. Because I'm sure it helps whoever watches. It helps me kind of put a bookmark into what it is that we're doing, right? If we're moving, someone's probably pinging. If there's an enemy, someone's probably pinging. But it does annoy the shit out of me. All right, yellow's here. I got a weapon of some kind, some sort. All right, your boy is not doing well here. Someone's behind me. Come on. No. Where the hell? Can I pull this off? Dude dropped here, didn't he? Almost positive he dropped here. Get me out of here. I think dude ran off. Could have sworn I saw him drop here. I think Red's in trouble. Don't touch my teammates. Oh, dude took my gun. That's what I wanted. You know what? That's fine. You can take it. Forces me to be a little more thrifty with my weapons of choice, but better with strategy. Maybe that's a play. What do we got? Anything good? Actually, yes. Not complaining here. We'll see. We'll test them both out. We'll see what's working best for me today. Not in love with that gun. The single fire isn't really doing it for me. Please don't mind if I do. Can't see anything because it's literally filled with smoke. I'll take my mushrooms. The ego on these people to take my mushrooms. Yes, we hear you. Could you shut the fuck up? This is why I hate it. I have eyes. I can see. What the hell are you seeing? You did all that pain for what? For nothing. But I got a gun out of it, so it's alright. What the hell is this? Yeah, I'm good with these guns, I think. Gosh, will I need a shotgun? I might, but you know what? We're alright. Who's not with us? Yellow. Where the hell is yellow? I'm thinking. Is there another car around here I can play with? I love these. These are the best. What is this, like a BMW? Look at that. BMWs in Fortnite. Who would have thought?
Kick back and kick up the jam.
Shut up. Kick back and kick up. Do I like my loot? I like my loot. Ooh, wait. Sorry, I had to. Big one for me. Come on. Oh, we actually have players. I didn't know that. don't even know where I'm looking. Whoa. Yeah, this is a whole circle. Nah, get out of here. Why? Yeah, don't do that to yourself, man. That's just awful positioning, man. I don't even know how to describe that. That's tough shit. They got a team full of hounds, and we were looting shit. Oh, dude. Pull off the impossible. They're gonna shoot your way now. They see you. No, don't do that. Silent strategy wins here. It's the only way to come back. Even if you're a god at this game, you're not a god from 4 different angles. While we wait for teammate to pull off the impossible, let's go ahead and keep reading. So I'm just going to reread. For example, assume that an investment of $10,000 is made with a 5-year life and returns $1,000 per year for 5 years, at which point the $10,000 principal is returned. Yes, that's 10% per year. ROI is simply the average annual cash flow divided by the initial investment outlay. Without giving consideration to the time value of money and also ignoring the negative cash flow of the initial investment and the positive offsetting cash flow representing the return of principal. RRR. As long as the return on investment is more than the RRR, the required rate of return, the minimum rate of return required to induce a person to make an investment, then the investment would be made. If the ROI is less than the RRR, then the investment would not be made. What the hell is this guy's deal? Wow. I would not have gone for that. I probably would have gone here somewhere, in front of the hill. But alright, let's go team. Let's go team. Here we go, dude. Show them why you're the best. Alright, this fish might be low-key a good friend. Where my stuff. Oh, damn, they took the good AR. You know what, I can work with this. I'm not gonna be ungrateful, I can work with this. Anybody wants that? I'm gonna regret this. So I jumped on accident. You know what? No, now that we killed that guy, I jumped on purpose. That's what happened. Now that I jumped on purpose. There's one more. Not gonna say no to that. Did they take my car? I know there are many like it, but this one is Fact. Mine. Okay. A little fender damage, just a tad bit. I'm on no kills for the night, and I'm having a great time. Are y'all just shooting at your thoughts? What are we doing here? I feel like I'm playing a bigger role than previously thought was possible. Okay, don't worry about it. What you can't control, can't get out. Be happy we survived that fight. Oh shoot. Ah, damn. What a good try, what a good try. These games are rough, man, because there's no positioning where pushing really isn't going to be necessary. Right? I'm very good at long range. I'm very good at being like the odd man out, but in terms of being the meat and potatoes that gets the job done, man, that's rough, man. But that team was good. That was a good team. I'm not going to put them down. When applying the ROI concept to investments, the return provided by stock investments has two components: dividends and growth in stock price, or capital gains. If a company pays a 2% dividend per year, and if the stock price is expected to grow at a rate of 6% per year, then the total return provided by the investment is 8%. Thus, the total return on investment is income plus growth. Income being dividends for equities and interest for debts. Mature companies tend to have high dividend rates and low growth rates. Growth companies tend to have low dividend rates and high growth rates. All other things being equal, the combination of dividends and growth should add to the same amount for both types of companies. For example, if a growth company pays a 1% dividend and is expected to grow at a rate of 7% per year, then the total return is 8%. If a mature company pays a 4% dividend and is expected to grow at a rate of 4% per year, then the total return is, again, 8%. However, there's a greater risk that the return generated by a growth company may vary than is the case for a mature company. Because of this, the market demands a risk premium, that is, additional return for a growth company than for a mature company, which makes sense. Next will be standard deviations. A bit of a... I'm not going to say hard topic, but it's not... They don't really use basic English, right? They use a lot of big words. And as long as you can break those big words down, which we can, we should be fine. No, I don't want to do that. Play in a place where we can get some cover. To say I've been relying on the car too heavily lately is a absolute understatement. I haven't even used my gun really. If I'm well positioned, I won't even have to use... What the f... This fool. Look where pink is on the map. Just... Can anybody spell the word idiot? Who here wants to help me out? No. I need this. I need this. Boy needs this. Okay, I needed more than that. Good gun. There we go. Okay, I can work with this. Actually. more now. Oh, you got him. Nice. You mind if I... one of them? Did dude really just leave us? Sounds like there's multiple. Don't get antsy. Actually. No. Hey guys. I'm getting my teammate killed. I'm actually getting my teammate killed. That's my fault. I didn't even heal up one bit. That. To be fair, I was in the middle of the whole fight, so. Go ahead, show 'em one. Show 'em one. Never mind. Oh shoot, there's 9 teams here. These aren't even like crazy hard lobbies. That's what's so funny about this. Standard deviation is the measure of risk of variability of returns. It measures the spread of the distribution of returns compared to the average return. Before showing how standard deviation is used, there are some other basic statistics that must be known. Consider an investment with the following annual returns: 4%, 6%, 12%, 8%, 10, 13, and 10% respectively, all in their individual years, 1 through 7. The average return is the mean. So you add all those numbers up and you divide them by 7 because of 7 years is equal to 9% average return. Median. The 7 returns in ascending order are 4, 6, 8, 10, 10, 12, and 13. The center return is 10%. This is the median, so right in the middle. The mode. Arranging the 7 returns in ascending order, they are 4, 6, 8, 10, 10, 12, 13. The mode is the return that occurs most often, which is 10%, occurs twice, while the others only occur once. The returns range from a low 4% to a high of 13%. So the range of the return is 9%, 13 minus 4%. I'm really not liking the noise of the game, so I'm gonna go ahead and play the game, and I'm gonna take off some of the noise because I don't like it. I really don't like it. I hate it. I think having those cues is enough for me to be like, all right, I'm good. Like, I don't want to hear it. I just want to play, you know? Don't want to strategize. Like this. Is this okay? Like this kind of works for me. I don't know why, but I'm not mad at this. Like, I'm really not. Because it's not like I don't already know that there are people around me all the time in this game. It's just a matter of seeing those little footsteps on your screen, then I'm good. I'm chilling. I don't want to hear this shit. Hayden Christensen as one of the skins for Caked Latte. I respect that. I can see they're making power moves here. These kids with their skins these days. What the hell? Okay. Got a whole bunch of people near me. I mean, I gotta. Whoa. What the Alright, this dude's just cracked. Jumping around, hitting his shots at the same time. I mean, yeah, I'm not gonna compete with that because I'm not gonna try that hard. My respects to you if you do. My respects to you if you do. But to say that I'm gonna care enough to get that good at the game, I'm just not. Just not gonna happen here. Some of us prefer to have our brains intact. Whoa. There's no way this works. Like this game is chalked. Whoa, how dareth you? How dareth you? Oh, this dude was low too. Ugh. Alright, so that's not gonna work. Let's try this. Let's see if I play any better. It's because I don't want to listen to this, man. It's the same noises over and over again. So I'm kind of just checked out noise-wise. I gotta feel the vibrations. I gotta do something different, you know. That's a lot more fun to me listening to the background music and playing this game because you don't play it the way everybody else plays it. You play it at a different level. See, this is what I was trying to do, but it didn't work for me. Zipline, it's probably coded so that it doesn't, you know, pick me up specifically. That's probably what this is. Okay. There's red. He's nowhere near me. Yeah, he's not gonna... I don't know. There's that most wanted dude. Let me read a little more. Now let's show how standard deviation is used to show the variability of investment returns. For example, we'll look at a company that generates the following returns. 6 years, and in each year they're showing 8% returns. The average arithmetic mean rate of return is 8% multiplied by 6/8, which is equal to 48%, divided by the 6 years, which is 8%. The rate of return is not varied at all from year to year, so the standard deviation of the rate of return is 0. How the hell did he die? Now look at a company that generates the following returns. 6 years, and it goes 12, 6, 8, 10, 4, and 8% respectively. The average arithmetic mean rate of return is again 8%. However, for this company, the rate of return has varied anywhere from 4 to 12% over the time period. Using these numbers based on the 6 years shown, the rate of return compared to the 8% arithmetic mean has varied from 4% below this figure to 4% above this figure. Right? That's what you're saying. Putting this simply, even though the average rate of return is 8%, the rate of return is just likely to fall to 0.5 of this amount. Half of this amount to 4%, and it is to increase 1.5 times above the amount up to 12%. Thus, the standard deviation of the rate of return for the short time horizon of 6 years is plus or minus 4%. Please note that this is a very simplified explanation of standard deviation. It is an incredibly simplified explanation of standard deviation, but I'd make the argument that some people aren't really willing to listen to even that, because statistics is usually taught by people who don't know anything about statistics, so it's kind of a, oh no! Oh, that could have been my bat, dude. Not angry at this. Alright, I'm a little more locked. I'm locked in. I feel good. I think, what the hell? I didn't know I could do that. Pump and dump on that sucker, man. Don't take my mini. Oh. You took my mini ammo. You bastard. How dareth you? The problem with this gun is that I prefer to want to shoot it more than I do, but it keeps that little lid on itself. What the hell? Not sure what they're shooting at, but if I've learned anything, if it has to do with bots, it's not worth it. Oh, it's a minefield. Oh my gosh, I can't aim. Can't aim here. Can't aim. I physically can't aim. Whoa, 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 whoa. Small ammo for your boy? Small ammo for your boy. The smallest of ammo for your boy. Oh, please, don't mind if I take the smallest of ammo for your boy. Any decent ARs here? Shows no, but these gunfights would say otherwise. Someone is hiding something from me. I don't want that. I don't want that ugly gun. Yeah, my AR of choice has to be that pump gun, man. That, triple burst, whatever it's called. It's just such an efficient gun, man. Even if it's in green, at least, like, you just gotta hit your shot one time. There we go, this one. You're gonna get shot back there, dude. Just letting you know. Is this quads or trios? Trio, I think. Go, man. Go, 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 go. What the hell are you doing? Jeez, dude. I'll better down him. I'll better down him. Oh. Wait, this is 4 people. Wait, is this quads? Is this quads? Yeah, I was kind of stuck there. It's my fault, I knew better. Should have taken a long range fight. Let's keep reading, shall we? Let's put total return and standard deviation in perspective for various types of securities. The chart below shows, oh, screw it. Just better. The chart below shows average total return and standard deviation of return for securities of different risk classes over a 50-year period. A 1-year treasury. Okay, so it has 3 columns. In column 2 and 3 is average total return and standard deviation. That's 2 and 3 in order. 1, 2, 3, 4, 5 rows down. Row 1, 1-year treasuries. Row 2, 30-year treasuries. 3 corporates, 30-year corporates. Fourth, large cap stocks. Fifth, small cap stocks. In order, it goes 5, 7, 8, 12, and 20 in the average total returns section. And standard deviation is 3, 8, 9, 20, and 35. All percentages shows you the variability in the returns. Notice from the chart that the security types are listed in order of increasing risk. Also note that both the average total return on that investment and the standard deviation of that return for each type increases. This is just what we would expect. Treasuries are the safest security. Because of their short maturity and government guarantee, investors will accept a lower total return on these investments, with the average return over this time frame being 5%. This is sometimes called the risk-free rate of return. Notice that the variability of the return is minimal, being within plus or minus 3% normalized. The rate of return is not likely to be less than 2%, which is 5 minus 3% of the standard deviation over time, nor is it likely to be more than 8%, 5% plus 3% of the standard deviation. Oh, dude, they didn't stay. Damn, they didn't stay, and this dude's nuts. He's on 8. Wow. That's rough, man. That's rough. Let me go ahead and lock it in for teammate here. Lock it in for teammate. Just in case he gets his reboot off. My mistake when I died was that I got out without the pump and dump. I started shooting with that burst or something. That was not worth it. Thanks, man. Appreciate you. Gotta get away from there. Don't play that. Don't be stupid. Don't do it. Don't die on me, teammate. Don't die on me. I need you on this one. Oh, shoot. Nah. No. If he died but somebody isn't around him, I can get him. But if they're right on his body, oh, they're right on his body. Gotta play position here, that's my only bet. Don't be stupid. Behind me, huh? Go. I gotta get physically lost in the sauce, man. I have to. Whoa. Yeah. Didn't have another option. These games are hard, man. These games are hard. Gotta hit a little bit of luck here. Luck with a teammate, luck with your shots. A lot of things gotta go right, but you just gotta practice, you know. On the other hand, small capitalization stocks are the most risky security. Investors demand a higher total return. Hey, bud, what's going on? Lay brother just walked in. Oh, nice. You got your Gatorade? Nice. Nice, dude. Nice. You look happy. Oh, yeah, he's happy. Hey, pal. What a beautiful guy. Hey. You got pants on or you want to put on shorts? Alright, I'll be here. He's going to go put on his shorts. Investors demand a higher total return on the investments, 20% on average. Thus, the risk premium on these is 15%. That is, these securities yield 15% above the risk-free treasury rate of 5%. The risk premium is apparently justified because the standard deviation of returns on these securities is 35%. Thus, while the average return is 20% over time, the return tends to vary greatly over time. It is just as likely to be negative 15%, 20 minus the 35% standard deviation, as it is to be 35%, which is 20% plus the 35% standard deviation as well. Yeah, okay. So they're adding standard deviation both upwards and downwards. I got to lock in here for team. So they're adding the standard deviation both upwards and downwards, which makes sense, right? That's kind of you have your variability factor here. That's fine. You have your variability factor, and the only way to really measure the kind of risk you're taking is look at it both ways with respect to the upturns and the downturns. The downturns can be negative, and some people, they really cannot afford that. There are tools for that, but, you know, you got to speculate to accumulate. That's the only way you can do this thing, man. Investing is not an easy thing, but it's also, you know, not going to be just handed over to you because you want more money. That's not the way. It's not the way this works. From my understanding, at least. From my time from being in the business, I guess is a better way to put it. Chest, anything? Nice, dude. Alright, I think we're okay. This is not terrible positioning. What am I looking for? This is not terrible at all. Ooh, I'm really not mad at this loadout. Pick my spots, you know. Grab that plasma if y'all want it. Call me crazy, I like these bags better. Jeez. Didn't get the loot, damn it. Yo, 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 yo. Hey, 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 hey. Blue, blue. Come on. Actually, no, I gotta stay high ground. I have to. No. I just... I don't know what it is. I really don't. Maybe I'm just too eager to hit those zip lines. I need a new gun. I need a new gun. Let's use my pump and dump magic while I could. Ammo, ammo, ammo. We can play that. Who's in car? on, man. Whoa, 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 whoa. It's the longest med kit I've ever used. Oh my gosh, these dudes are nuts. These dudes are nuts. And I know it's them being nuts too, because I'm not like... I know I can be pretty bad at this game. But I'm not buck stinking awful. Like, these dudes are... They're good. They're players, man. They do this for a living, or at least they want to. Anybody who gives this much of a shit about a game, to be good at it, has my respect, man. This shit ain't easy. Shit ain't easy. Another way of looking at risk premium is from the standpoint of risk-adjusted rate of return. It seeks to compare the risk premium incremental return earned above and beyond the risk-free rate of return. Maybe change the frequency a little, huh? See what we got.
All you gotta do is
All you gotta do is shut the fuck up. How about that? Who's that clown? It seeks to compare the risk premium incremental returns earned above and beyond the risk-free rate of return. Am I listening to anything? Hello? Okay, it didn't freeze on me. Ooh. Doing something. I like this. I like this frequency. It's got a thing to it. I don't know what it is. That's the beauty of it, right? All right. Where are we landing? Pumped Power. I think I've been here a few times. I also have my screen at the lowest brightness so it doesn't burn my eyes, which also is like it's a mess up to my concentration, because if I see someone shooting at me, I don't know who they are because I can't see them physically, right? I might be able to see them on YouTube later when I'm looking at a bright screen, but for long periods of time I turn the screen down, 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 down. Play my best hand, start here. Come on, come on, come on, come on, come on. shots to my rightness. This guy doesn't know that I have an arsenal of weaponry on me. Are you kidding me? Whoa. Get absolutely turned on, kid. Get turned on. Nice. Get turned on, dude. Dude, you're so bad. You're so bad, dude. You're so bad. These kids are absolute gods who play this now. You get that gold. Let's roll. Did our team leave? Why? That's what I'm talking about, man. That's a good gun, actually. I feel like this is usually a rotation, right? Whoa. Follow me. these dudes, man. Don't get too excited just yet. Is that everybody? The fact that I even got that. The fact that I even got that. I can't give up this high ground, so I gotta... I see it. Hey, bud. How you doing? Oh, shoot. No, 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 no. You're kidding me. Hey, Bubba. Good to see you. That's kind of... Alright, this is good enough. This is giving us high ground. Thanks, man. I don't have any loot, man, so I gotta check this out ahead of you, so... Does everybody just have no ammo? This is unbelievable. There's got to be some ammo. Ammo here looks like a decent... I'm not going to say not that I didn't have a decent gun, but you know what I mean? Yeah, top off. It's just because I want to... These dudes are coming in from beyond the circle, so... That's fine. Rather than miss us by... Oh no. What was he at? What was he at? 16 health, yep. You know what? The fact that we didn't have a team and we went that far, I'm cool with that. I can work with that. I can live with that, right? I got a new Blue Eyes White Dragon today. Little collectible, Dollar Tree. Oh my gosh, so much better than the cards. These feel real, you know? Feels like they can do something. Hey, Bubba. Gonna take a little nap time? You can take your socks off, stay a while, enjoy yourself. I don't think this was too bad either. I thought this was, not nothing, you know, feel this? Feel that. You know? I can be watching like a frequency video, right? And then the ad would be like, do you want to go to the ocean to see the waves? Put that down, bud. Put that down. Here you go. Take off your socks. No. Ooh, I like that. I like this. I like this. What are the uploads at? I really like this video. I thought this video was very relaxing to make. No stress. Didn't care about the wins. Cared about having a good time. And found out that I like driving the car. The car is one of the most valuable weapons. People don't even know it. Risk-adjusted rate of return will be next. I'm trying to see how far ahead we need to go. It's not too bad of a chapter. Somebody better mark. 3, 2, 1. Okay. Y'all better jump with the team. Y'all better jump with the team. Not a bad start, dude. I see someone moving on, teammate. gonna take a nap time, Bubba? Yes. Love your voice, you know that? Love the way you say yes. Did you have a good day today? Yeah, did you go to church? And you saw the nice people? And did you have a little snacks? Yeah, snack time, huh? Had some cookies and some bread. It was good, wasn't it? I love these pouches. I don't know what it is about them. You won't win this fight, I guarantee it. Quit playing with this kid, man. Quit playing with this kid, man. Quit playing with him. I made him feel like he had a chance, you know. You gotta, to break people's dreams, you gotta build them up pretty high, you know what I mean? Where did this guy crawl to? Wow. We're going opposite ways. Why are we going opposite ways, man? This never ends well, pal. I'm watching you. I'm watching you. Hey there. Hey, lovely guy. Hey. Don't mind me, just taking a load off. top, I see. Yep, stupid move, man. Stupid move. Should have taken that fight on. Now you screwed me over, too. Whoa, 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 whoa. Oh, I didn't. Oh, you're Glenn. Two different teams? No. Actually, yeah, they might be two different teams. No, it's one team. Why did we split, man? Why? The absolute stupidest thing we could have done. Swag Kitty Yola was driving. You know what? That's my fault. That's my fault. That's my fault. That's my fault. I didn't see Swag Kitty Yolo's name. If I had saw the name, I would have known. Get the hell out of the car. I would have known. See, Captain Josie, Captain Funes, right? Those are the kinds of people I want driving, right? They're the captains. You got one card. Now you gotta get the most important card. That ain't it. That ain't it. You're gonna die. You're just bad. You're missing the mark. No, dude, behind you. They're right there behind you. Look back, look back, look back, look back, look back. Yep, you saw him, you saw him. No, play that rock. Actually, yeah, all right, left. Great shots, one at a time. Here we go. Shotgun. All right, talk about bots, man. Does this guy die within the next 5 seconds? All right, got to it before I could even get it out of my tongue, man. We'll spectate. We'll spectate what a team is really supposed to look like while I do some reading. Another way of looking at risk premium is from the standpoint of risk-adjusted rate of return. It seeks to compare the risk premium, incremental return earned above and beyond the risk-free rate of return, to the incremental risk assumed by making that investment. There are a number of ways of measuring risk-adjusted rate of return, but the most common is the Sharpe ratio. The Sharpe ratio seeks to measure reward as defined by the risk-adjusted rate of return versus volatility as defined by standard deviation. The Sharpe ratio in formula form is total return minus risk-free rate of return in the numerator over portfolio standard deviation. So, historically, Sharpe ratios for various asset classes are Treasury bills 0, Treasury bonds 0.20, S&P 500 index 0.35, mid-cap stocks 0.45, small-cap stocks 0.55. So the S&P is right in the middle of that, right? It's not too safe, but it's also not too aggressive. It's pretty in between, right? It's not going to be the best investment in the world, but it's also not going to be the worst, you know? When making an investment decision, the Sharpe ratio of the specific investment should be compared to the lowest matching asset class. If it is higher, then the investment gives a greater return per unit of risk assumed as compared to the asset classes and is a good investment. If it is lower, then it is an inferior investment as compared to that asset class. Another factor to consider when measuring investment returns is the effect of compounding on the return achieved. The average annual return that an investment generates is the arithmetic mean return. The compounded average rate of return is the geometric mean return. For example, assume that an investment generates the following returns: year 1 plus 20, year 2 minus 10, year 3 plus 20. The arithmetic mean is plus 20 minus 10 plus 20, which is 30%, divided by 3 years, which is 10% a year. However, this is not the actual average return achieved. If this individual started by investing $1 in year 1, then after the first year, the investor would have $1.20, 20% return. In the second year, the investor lost 10%, so his investment is now worth 90% of 120, which is 108. In the third year, the investor grew by another 20. Oh, another 20 on the $1.08. Okay, I see what they're doing. And he ended up with $1.29, so 30 cents, $1.30 basically. So at the end of 3 years, this investor has approximately 30% more. This is an average annual growth rate of about 9% a year. Thus, arithmetic mean return of 10% overstates the actual compounding geometric rate of return, which we computed as 9% by 1%. Got it? For the exam, you will not need to compute geometric rate of return, but you must know that geometric average rate of return takes compounding into effect, while arithmetic average rate of return does not. Other measures of evaluating, that's a good point, right? The geometric way of looking at things is kind of in a straight line as opposed to stepping stones, right? How much money did I have? Here. Okay, now let's check how much that return would give you back in that specific year. Well, we're not looking at that specific year. We're looking at all the years in total, right? Geometric, it's compounding. You're accumulating the effect, and that's how you're going to count it, so to speak. Other measures of evaluating portfolio investment returns consider the following: the probability that the return may vary, the fact that the holding period of an investment can greatly affect the investment's return, the bite that taxes take out of investment returns. The expected return of an investment is the calculation of the weighted average of its possible returns, with the weighting being the probability of achieving each scenarios. For example, assume that the investment return of a company's stock varies directly with economic conditions, a cyclical stock. Let's also assume that there are 3 possible economic scenarios forecast for the upcoming year, with the following probability of occurrence assigned to each scenarios. Deep recession, 25% probability of occurrence, a negative 5% projected return. Low GDP growth, a 25% probability of occurrence, a 4% projected return. High GDP growth at 50% probability of occurrence and 12% projected return. The expected return is calculated by multiplying the probability of each scenario by the projected return and adding these up. This computes as follows: a deep recession showing the expected return as negative 1.25%, low GDP growth showing the expected return of 1%, and high GDP growth showing an expected return of 6%. Over a short period of time, it is unlikely that the expected rate of return would be achieved. The probability of actual returns being different from the forecast is too great. However, over a long time horizon, given that the assigned probabilities are close to what is really experienced, the expected rate of return should closely match the actual rate of return achieved, keeping all other factors constant, of course. Another factor to consider is that if an equity investment is held over a long period of time, the expected rate of return will not change much, but the variability of holding period, compound returns, falls dramatically. This occurs because there is more opportunity for good years to offset bad years when stocks are held for long time periods. If stocks are held for short time periods, then the holding period rate of return can change dramatically. Another way of looking at this is to say that the standard deviation of returns depend on the holding period of investments. Thus, the shorter the holding period, the greater the variability of the return. And the longer the holding period, the smaller the variability of return. Okay. Common stock price volatility may hurt short-term holding period performance, but over the long term, the equity risk premium that common stocks give produces a superior return with much lower overall volatility. Thus, returns achieved on an investment are highly dependent of the investor's holding period. In the short run, returns can be dramatically lower or higher due to the changes in economic conditions. However, over the long term, returns do not change much for each class of investments. Another factor to consider when calculating portfolio returns is that the bite taxes take out of the investment return. The after-tax return is calculated by deducting out all applicable taxes from the investment yield, which makes sense. I mean, it's only natural. It's going to happen one way or another. For example, if a customer buys a corporate bond yielding 10%, and if the customer is in the 40% tax bracket, then 40% of 10% return, 4%, goes to pay taxes. The remaining 6% is the after-tax return on the investment. What are we doing here? Are we stalking our prey? You see some flying? I don't know if you want to take these shots. Oh, minigun? That's doable. But you didn't hit any of your shots. Ooh. So sorry. So sorry. Rubbing my brother's little face. So sorry. So sorry. Didn't hit your shots. Didn't hit your shots. You want a little hair massage? Hair massage. Hair massage. You gonna take a nap time, Bubba? All right, take your nap time. I'm right here. Don't worry. Rubber's not going anywhere. He's right here taking care of you, little man. Crazy little man. The formula to compute after-tax yield for taxable investments is taxable yield multiplied by 100% minus the tax bracket. Another consideration regarding after-tax yield is that interest income is taxed at a different rate than both cash dividends received and long-term capital gains. Interest income received is taxed at a max 37% rate, while cash dividends received and long-term capital gains on assets held over 1 year, are taxed at a max 15% rate. When computing after-tax yield, the appropriate tax bracket percentage must be applied to each type of income realized from the investment. Please note that if a customer buys a municipal bond where the interest is free from federal income tax, then the yield of the investment already is after tax, since no tax is due on the interest received. Also note that capital gains on municipal bonds are federally taxable. In measuring portfolio returns achieved by a manager, comparison is made to a benchmark portfolio. Institutional investment managers typically specialize, so to compare the investment return of a specialized portfolio to, say, Standard & Poor's 500 would not be very relevant. Portfolio returns achieved by a manager need to be compared against the relevant benchmark. For example, the return achieved by a manager of a small cap fund might be measured against the performance Russell 2000 index, which is an index of 2,000 small cap stocks. A manager's active return is the difference between the return achieved versus the benchmark return. This measures the value of the manager's performance. For example, assume that person who buys the Russell 2000 fund shares achieve a 15% annual return. This is a passive return. Assume that the manager of a small cap stock portfolio achieves a 20% return over the same time horizon, okay? The manager's active return is 20% minus 15, which is 5%. This is the excess of return over the benchmark portfolio achieved by the manager. Another measure that can be used is the real rate of return. This is the excess of return from an investment over the current inflation rate. For example, if an investment yields 10% and the inflation rate is currently running at 3, then the real rate of return is 10 minus 3, which is 7%. Okay, so real rate of return is just the nominal minus the inflation rate. Yeah, fair. Any returns achieved must be reported in a manner that is consistent with the way in which yields are generally measured, that is, in time periods of 1 year. If a manager achieves a return of 10% over a 6-month time horizon, the annualized rate of return is twice this, or 20%. Actually, it's a bit higher than this if compounding is factored in, they say. Conversely, if a manager achieves a 30% rate of return over a 3-year time horizon, the annualized rate of return is 10%. Actually, it is a bit less than this if compounding is factored in, right? Time-weighted average return is another measure that must be known. It is the measure used by mutual fund performance charts and shows the growth of a one-time investment over a fixed time period. Mutual fund performance charts show 1, 3, 5, and 10-year growth. Time-weighted average return reflects a buy and hold strategy. A single investment is made, no more investor cash inflows or withdrawals occur, and all dividends and capital gains are reinvested. Another name for this is total return of the fund. This method allows for a consistent comparison of one mutual fund's performance to other funds. In contrast, the return that an individual investor achieves in a mutual fund is dependent on when money is deposited into the fund and when withdrawals are made by that investor. An investor-specific return in a fund is the dollar-weighted average return. Dollar-weighted average return is the same as internal rate of return, which is covered in the next section. Because mutual fund investors often chase past performance, they will often time their investment into a fund too late after the fund has posted its best performance, which attracted new investors, and now the fund enters a period of lesser performance, right? Because you're just buying at higher prices. And these investors will also sell too soon after a period of poor performance. Discourages the investors, so they sell and do not enjoy a following period of improved performance. They're not riding the wave, so to speak. Thus, for the individual investor in a mutual fund, dollar-weighted average return is often lower than time-weighted average return. Yeah, I would assume so. Okay. So good to know. Let's go ahead and lock in, huh? Dude, what the fuck? Get rid of these ads. Let's go ahead and lock in. I was gonna put it on while I was gaming, but I was like, I'm gaming for like a few minutes and then I'm not, and when I'm not, I'll put on the vibrations. Alright, there are people here, and chances are they are real players. I need this. Jeez, man. What a fight. Felt like we couldn't breathe there for a second. Can y'all quit playing with me, please? Oh. I love these. Fellas. Idiots. Yeah, I guess that's best use of my gold right now. Don't think I... You idiot. Don't die on me, yellow. Took all my loot. It's not enough just to win, you know. You gotta get a satisfying win. You gotta get, you know, a minimum number of kills. You gotta do good, right? Nah. I don't think they're ready for it yet. Don't ego that, don't ego that, don't ego that. Shoot. Oh, you idiots. Why'd they leave? I saw that llama. you want me to do about it? Come get this gun, you moron. Yes, I know where we are. Okay, so we're here. We gotta go. Whoa, 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 whoa. Don't threaten me with a good time. Shoot, where's Blue? In there with me, Blue? Let's get out of here. Someone Blue can loot up. Thanks, man. Appreciate. Loot up for yourself. I got you. Get better angles, get better angles. Come on. Let's play the hill if we can. Oh, two angles. Two angles. Thanks, kid. You're a real trooper, you know that? Oh. I wonder why that happened. Oh man, I pulled off a revive. I normally don't stay back for teammates to pull off a revive, but I felt like I had to here. How far are we in this chapter now? It's gotta be 3 hours, right? It's been wild. Okay, not bad. 2 hours 25. I'm gonna take a Waz. I'll be right back. Trying to fight trios might be a better move. It's typically how I go, but, you know, quads, you usually hope you just find one good teammate or whatever, but, you know, quads is way too complex to, you know, not have one teammate and think you're going to win. Too many moving pieces against your own interests, so. Annualized returns. Any returns achieved must be reported in a manner that is consistent with the way which yields are generally measured, that is, in time periods of 1. We did that. Time-weighted average return is another measure that must be known. It is the measure used by mutual fund. Okay, we did that. Time-weighted average return reflects a buy and hold strategy. A single investment is made, no more investor cash inflows or withdrawals occur, and all dividends and capital gains are reinvested. Another name for this is total return of the fund. This method allows for a consistent comparison of one's fund performance to others. Okay. You should kind of be happy with the fact that you get any return. I mean, there's a real argument to be made that, you know, you don't ever feel like you'll see those returns. You just don't. You feel like you should. You hope you will. But I don't know. I feel like money's just there in case you don't die tomorrow, you know? Like, it's a way for you to just kind of chill the hell out. My pen. My pen has just fallen, and it cannot get up. Where are we at? Let's do that. Don't bother me. I'm gonna take my time. I got those kills for that guy, so he can wait. Oh. Dude, no, I can't. Everybody's always got shields. I gotta sit this one out. I can't. I don't want to fight this. It's always some BS that gets us chewed up here at the bank. Not that I'm not all about it, but you know, sometimes you just want to win the game, not deal with all that other stuff. Let me put it to you this way. In this game, the people I choose to shoot at, I prefer them not be bots. Hey, Ricky Dabs from last game. You might want to... Maybe we can be friends. Maybe we can be friends. Oh, nice. What do we say, Ricky? What do we say, huh? All right. Yeah, let's not split from team. Let's not split. Don't split. You know, we're all good, but we're not that good, you know. That's why we play quads. Come on, Blue. They'll just keep annoying the shit out of each other with this. Get the hell out of here. Yummy, yummy, yummy. In my tummy. It's a rich man's world. Yeah, I'm cool with these. Wait. Let's go, let's go, let's go. Jeez, man. Dudes are shooting at nobody. Yeah, get that hill, get that hill. Let's go, win it. Thank you, sir. Go, 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 go. Let's go, let's go, let's go, let's go, let's go, let's go. They're in the storm. Let them die. Let them die. Don't be stupid. It's your fault if you die. got too cute. Where did the other teammates go? Oh. Right, I went right to bank and... it's just lack of comms, lack of structure, lack of strats. That's on me. That's on me. Should have known better. If they revive me, oh, behind you! Whoa, dude, whoa! I don't know what you're doing, but how do you check? What was I gonna say? Like your teammates. How do you check who has kills and whatnot? Funny enough, it's me and Ricky who are left over. Use your boost. What are you? See, that's kind of what happens when you have those, or that's what happened to me. Too many guns, not enough heals. Right, you're thinking too much about the aggressive side, not the regressive side. You gotta have a little of both. If I could go back, I'd probably just grab the drill, the AR. The drill, the AR. The bat or pump and dump? I mean, that's kind of the $1,000,000 question, right? I feel like I can work with the bat really well. I work with a pump and dump well as well, but late game, you don't want to make it hard on yourself. Just grab a bat, you know. All I can do is hope for the best. Alright, these are the guns I'm gonna go with. Go get him, go get him, go help, go help, go help. I see. Ooh. Landing high ground is gonna be rough. Damn. I got a shot off, but damn.
These lobbies are cracked, man.
These lobbies are cracked. High ground was the play, but, you know, they had a bat. I didn't. I had a few shots to hit, but nothing more. Oh, yeah. This is just an unbelievably cracked lobby, man. Let's go ahead and try trios after this. Note to self, trios. Finally, the basic formula for compound interest, also called compound value of a sum must be known. Assume that an investor of $1,000 is expected to grow at a rate of 10% per year for 3 years. In this case, then at the end of each year, the amount of the investment should be 1.1 times higher than at the beginning of the year. At the end of 3 years, the value of the investment should be, and it multiplies the initial 1,000 times 1.1 for 10%. At the end of year 1, in that balance, it gets multiplied by 1.1 again, and so on and so forth. By the end of year 3, you have $1,331. Sorry. So the basic math you would think is essentially linear, but it's not because of the compounding effect. All right, the little pennies and cents make a difference. Future value. Future value equals P for original principal amount plus 1, or P parentheses, so that's multiplied 1 plus the interest rate raised to the nth number of years of compounding. The portfolio that is properly constructed includes stock selections based on investment objectives of the owner. As more and more companies operating in different industries are added to the portfolio, diversification increases. This reduces the risk of loss if any one of the investments turns bad. In portfolio theory, this is termed non-systematic risk. As the portfolio is more completely diversified, the risk is minimized. Let's go ahead and just let's do some of that. Risk is minimized. Where was I at? Here we go. However, if the market as a whole tumbles, your investment will decline as well. This risk is termed systematic or market risk and cannot be minimized or eliminated by diversification. To summarize, the risk of a general market decline affecting the portfolio, called market risk, and cannot be diversified away, is called systematic risk. The risk of a single investment going sour, also known as selection risk, by diversifying the portfolio. This risk is minimized, and in addition to systematic and non-systematic portfolio management entails capital risk, which is the risk that the amount invested may not be fully recovered, and timing risk, the risk that buying and selling occurs at disadvantageous price levels due to poor market timing. Makes sense. I mean, from my understanding, there's just so much that goes on in the market that trying to predict it is like, it's like trying to predict the lottery. It genuinely is. You're not going to predict the lottery, but you can predict human behavior. And that's really your best weapon for diversification. You're not going to be able to diversify the risk of the market tumbling away. That's going to happen. It might happen more than once. It might happen more than twice. It might happen a few times. Right? Things will happen. You can't rightfully predict that kind of stuff, even though we want to. It just isn't gonna happen. Alright, well, I had to. My big thing is that at least I can trade, right? I can trade with them. Shoot your gun! The fact that the ego to think that people won't see you. You think you're slick, but you're not. I know what you're trying to do. You're about to get shot in the back. Yeah. This guy. No, the wall is not your problem. Next subsection is a Monte Carlo simulation, a computer-driven mathematical technique for estimating the value at risk in a portfolio is known as Monte Carlo simulation. This technique assesses the probability of achieving a given portfolio return under different scenarios, with the scenarios varying based on different market interest rate levels, different inflation rate levels, different economic growth rates, different stock price growth rates. There are thousands of potential outcomes to these simulations. Yeah, it's basically telling you there's way too much that goes on for you to ever really predict it. Hey man, thanks. Tried my best here, but guess it just didn't give, you know. What the hell is Blue doing? Blue! Wait, what? Who the? Why? Are those bots? Why were bots shooting at each other? I don't understand. Maybe it's because I don't play this game enough? I'm gonna take care of this game. That's not what I meant to do. Solid start to the match. See, that's why I hate bots. You can't tell which ones are bots and which ones aren't sometimes. Or I can't, at least, or I don't know that good. Yet. Whoa, dude, whoa. Oh, TB. Don't tell me you did that to yourself, TB. If it makes you feel any better. I've been there before. What the hell is this clown at? Don't. Wait. When I can hit that zip line, I want to hit it. This is redemption. There's Blue. I really didn't think I needed that. I really didn't. Hey, waste a little gold. You know what? If you live and you learn. Come on, pink. Not seeing any footsteps, which is not the worst thing in the world for us. Yeah, that's a good idea. What the hell are you doing? Wait, I want to go there. I want to see what that's about. Wait, what? Dude, what? Hey, dude. I didn't know this place existed. Actually, really lit. Really nice. Just one tag. Oh, this one's gonna be easy. Easy. Nice job, get it when you're ready. Sorry, dude, it was kind of annoying. Poor kid. I mean, dude's escaping me, man. How in the hell is he doing this? Jeez, man. We're moving here, we're moving. No, why are we going back? No, I refuse. I'm not going back. About them getting to the zone, that's not your business. It's not your business. What a silly rotation here. Hey. How are there 10? Oh, because the circle hasn't moved yet. They're going to be coming in from over there. over yonder. Yeah, I know. I see him. Oh no. I rushed it, I got nervous. The pump was a better move. But I rushed so cleanly. We'll spectate this. We'll spectate it. Thought that was a good rush. Thought I did okay there. Huh, pal? What do you think? Think I did alright? You think I did alright? I think I did alright. A little scared towards the end, but you know, it is what it is. What would I have done differently now? The AR was good. The AR was a good choice. I think the pump just gives you too much. Not the pump is the wrong word. The bat gives you too much confidence to go in there and just 1v everyone, and that's really not my game. If I would have pump and dumped, I think I would have used. I think I would have had a bit of a calmer mind, because that bat is pretty much just swing and pray, you know. Oh gosh, so close. Efficient market theory. Portfolio theorists measure risk by computing a correlation coefficient called beta. Beta is derived by performing what is known as a multiple regression analysis. This is a statistical process where price movements of a given stock are correlated to price movements of the market as defined by a market index. Beta measures stock price volatility based solely on general market movements. The higher the beta, the more volatile the stock relative to the market. Beta solely measures price volatility of a stock relative to the market. The fundamental characteristics of that stock are ignored when computing beta. Right, beta is just looking at the ticker as it is as a digital way to track numbers. That's it. It's just tracking numbers. For example, a beta of +1 means a stock is exactly as volatile as the market, with the usual market indicator being the S&P 500. If the beta is +2, this indicates that the stock moves twice as fast as a market. If the beta stock has a beta of -1, this means that when the market moves up, this stock moves down at exactly the same rate. Countercyclical, such as gold, would fall into this category. If a stock has a beta of -2, this means that when the market moves up, this stock moves down twice as fast. Very few negative beta stocks. Such good games, just not finishing them, you know? Had a great hiding spot. That was a great hiding. I should have made them come to me. Should have played that and peeked it. Worst case scenario, they have, rockets or something, and if they do, we get out of dodge, just in time, but gosh. kind of just want to hit someone in the face with the pump, you know? Damage is so high, they just... brain stops working, you know? How much gold am I working with here? I might have to... get me some black market items here. Gonna need that late game. This and... Ooh. I don't know, I feel like this orange AR can kind of substitute as some sort of shotgun, if you will. Just because it doesn't really require you to aim all that, you know, accurately. Do a little more, don't need more heals, or don't need more weapons. Like, I don't care about doing the bank heist, I really don't. Grab that. Oh, you got a purple? Nice. grab it. There you go. Wait, no, use it. Somebody. Oh, that's a blue. Nice. Somebody grab mine. Got it. Ooh, no, don't get cute with it. We'll run with the guns. Oh, I got the pump and dump too late. Blue. There you go, blue. Hey, get involved, blue. Here we go, blue. Oh, do it to him, blue. Oh, blue. That's alright. Where's pink at? I'm gonna stop here because this is where my good stuff is at. This is where the good stuff is at. No, shoot. Let it go. Let it rip. What are you doing? No. Gold. Gun. That's what it's there for. Play with new team. I hope I play with A team. Let's move on. Stocks that are noted for their high positive betas are airlines and toy companies. Their price movements are quite volatile since their earnings are quite volatile. Stocks that are noted for their low betas are drug companies and utilities. Their prices generally move more slowly than the market as a whole since their earnings are generally consistent from year to year. As more and more securities are added to any stock portfolio, the beta of the portfolio must approach that of the overall market. Thus, a completely diversified portfolio would have a beta of 1, indicating that its movements match that of the overall market. A portfolio with a beta of 1 would only be subject to systematic risk. All non-systematic risk has been diversified away. A portfolio with a beta of greater than 1 indicates that non-systematic risk is still present in the portfolio. Regarding the price volatility of options, a similar measure is used called delta. The delta of an options contract measures how fast the price of the option moves in response to a price movement in the underlying stock. For example, if a stock price moves from $50 a share to $51 and the underlying call option contract moves up in price by $1, the option premium has a delta of +1. If a stock price moves from 50 to 51 per share and the underlying call option contract moves up by 50 cents, delta is +0.5. And then you see the pattern. If the contract were to go up 25 cents, it'd be a delta of +25, right? There's a correlation metric for here as well. And then we got the final 2 pages. And these are pretty important pages. I mean, this is the first chapter of the book. They put pretty heavy stuff here at the beginning. Hey, Paul. Take a nap time. That's what nap time. Then we can go watch, or you want to watch cartoons? Alright, let me finish this reading. We'll go watch some cartoons. Would you like to see Magic School Bus? Magic School Bus. Alright, that's what we're gonna do. That is what we're gonna do. That's what we're gonna do. Relax your eyes, Bubba. Relax your eyes. Don't stress yourself out. No deal in stressing. The seasons will come, the days will blossom. Your worry about tomorrow will never end. until you realize tomorrow will never come. You'll be alright. Just enjoy the feeling of today. Alright, I'm kinda shoot. Hey, Pink, you're not gonna leave me alone like that, Pink, are you? Pink. See, these are not teammates that I want to work with. They're just not. You know what? But this might be the best chance to read the last few pages. Read the last few pages. And then last game, and then go watch cartoons. Alpha, unlike beta and delta, is not a price volatility measure. In its most simplistic form, alpha is the excess return of an investment as compared to the risk-adjusted return of the market. If a stock produces an excess return over the risk-free rate of return of, say, 6%, and the excess risk-adjusted return of the market during that period was 4%, then the stock has an alpha of 2%. For example, assume that during a given period of time, the overall stock market, which has a beta of 1, is up 20% in value. XYZ stock, which has a beta of 1.50, is up 30% during the same period. Assume that the risk-free rate of return is 0%. The alpha of XYZ stock computes to 0. To find this, the following are compared. The excess actual rate of return given by this investment over the risk-free rate of return. Actual return of specific investment minus the risk-free return, which is 30 minus 0. The excess return of the benchmark index over the risk-free rate of return was 20 minus 0. To compute alpha, we must compare the rate of return that the benchmark index would have given if it had some quote-unquote beta as a stock. Since the stock has a beta of 1.5 times 20%, excess benchmark return being 30% risk-adjusted, excess benchmark return of the market index. Since the actual excess return of the stock was 30, the stock has an alpha of 0. The actual excess return of the stock, 30% minus the expected excess return of the benchmark index, 30%. This means that on a risk-adjusted basis, an investment in the stock was no better than an investment in a benchmark index. I see what they're saying, because it tracked 1 to 1.5 as opposed to you outperforming that 1.5. If you had a 31% outperformance and you outperformed by 1%, I get what they're going at. An alpha of more than 0 indicates that the investment outperformed the market on a risk-adjusted basis. A negative alpha indicates that the investment underperformed the market on a risk-adjusted basis. Market theorists believe that the market is efficient, meaning that information is instantly available to all participants and there are no impediments to buying and selling. In reality, this is far from true. When constructing a portfolio, the stocks that are selected should be those that offer the highest return with the lowest risk levels. These are the stocks along the efficient frontier. For example, following is a chart of selected New York Stock Exchange issues comparing return on common equity to overall risk. And it shows I've seen this graph before, it's the efficient frontier. Look it up, finance on Google, efficient frontier. The companies are plotted with an identifying letter, company A, B, etc. The best combination is the highest return for the lowest risk. These are the companies plotted upwards towards the upper left-hand corner of the diagram. The line that is drawn is called the efficient frontier because it represents the companies that offer the highest return relative to risk. Capital Asset Pricing Model. The methodology for identifying these investments was set forth in the Capital Asset Pricing Model, the CAPM. The CAPM breaks down an investment's return into a risk-free rate of return. The rate of a security only having systematic risk plus a risk premium, the unsystematic risk component. The market pricing of an asset must take both of these risks into account. So CAPM is the expected return of a specific investment being the risk-free rate of return plus the risk premium, and the risk premium being beta multiplied by the excess of expected market return over the risk-free rate of return. Simplified, the risk premium is the excess of expected market return over the risk-free rate of return, multiplied by the risk level of that investment as measured by beta. For example, ABCD stock has a beta of +2. The expected market rate of return is 7%, and the risk-free rate of return is 2%. What is the expected return of ABCD stock? The risk premium is 7%. Expected market rate of return. So 7% expected market rate of return minus 2% risk premium equals 5% times the +2 beta, so 10%. The expected rate of return of ABC stock is 2% risk-free rate of return plus 10% risk premium. So 12% in total is the expected return of ABC stock. So it's a simple formula, but it's more complex than that, but that's about as simple as they can really make it. Can this dude outperform for his team? Look at these two teammates. Look at them suffering together, working through it, going through it, even though they know someone's right on their ass, pinging for their friend to help them, to keep an eye on this guy, to stop using his sniper and to go get a shotgun and put it in that fucker's face. That's what they want. He lets his boys die, but he keeps the other one alive. It all comes at a cost. It all comes at a cost. He's got his friend's cards. Oh wait, that dude died. No, he didn't die. Note that the 12% return calculated using CAPM in this example is the minimum RRR, required rate of return, to make this investment. Another name for the RRR is the hurdle rate. This is the minimum rate hurdle that must be cleared in order to make this investment. Efficient market theory holds that securities priced instantaneously and fully reflect all available information. Because of this, random selection of a portfolio should provide a return that is as good as selection by any other analytical method. In essence, the theory says that there is no way to improve on the return that the market is giving. There are three versions of this theory. The weak form, which states that securities prices only reflect old information, thus attempting to predict future market movements based on historical data is impossible, because what has happened in the past is not necessarily a predictor of the future. Semi-strong form, which states that securities prices fully reflect all publicly available information. Thus, the use of publicly reported information to select stocks cannot result in a better return, since their prices already reflect this information. And strong form states that securities prices fully reflect all information, whether publicly available or not. The only version of efficient market theory that is widely accepted is the semi-strong version. Essentially, it states that insiders who have information that is not publicly available can select stocks to generate a better return than the market, since the market price only reflects publicly available information, not inside information or private information. Thus, under the semi-strong version of the theory, the average investor cannot do better than the market by selecting specific stocks. The growing popularity of index funds purchased by individual investors attests to the fact that more and more people understand this theory and the reality behind it. The reality being that you can't predict what's going to happen better than the people who are making those things happen. You just can't. And those people are probably benefiting, but you're not. You know, a car is a major asset in this game. You just gotta use it right. Shoot him, shoot him, shoot him. To your left, yeah. Zoom out. There you go, here we go, here we go. I like that, I like that. Start shooting. Behind you. One more. Look up. Here we go. Contrary to the efficient market theory, behavioral finance theory looks at the psychological behaviors that can result in making irrational decisions based on their own biases. From this perspective, markets are not always efficient and often react emotionally rather than rationally. While political risk is associated with instability within a given nation's political system, geopolitical risks are more broad-based. Geopolitical risk consists of threats related to competition or conflict between nations. It could improve competition between states for natural resources, markets, or trade. It could also include the risk of events such as war, terrorist acts, or any unplanned hostile action that could negatively affect international markets. Sector risk is associated with not properly diversifying investments across different economic sectors. An economic sector is a segment of the economy that is focused on similar industries. Examples of sectors include the energy resources sector or the construction and manufacturing sector. Companies in the same economic sector are likely to see gains and experience losses at the same time. So if an investor's portfolio is focused primarily on one economic sector, it is likely to lose value when that sector performs poorly. Diversifying investments across different economic sectors is the main way to combine sector risk. That is the end of Section 3, Chapter 1. I'm gonna do one more game. I'm gonna lock in. I'm gonna turn off the feng shui just to, the feng shui really is there for me to be able to read, and I don't want to say enjoy. Enjoy is the wrong word, but kind of be peaceful when I'm reading. It's very easy to get hectic, especially when you're listening to all this Fortnite, bullshit. People shooting, people doing this, people getting down. It's a whole enchilada of things I really don't care too much about. Except for when I actually do focus, right? If I'm playing with Johnny, right? Obviously I want to focus. I want to look good for him, to a degree. I want to make sure I don't embarrass myself too much. I know I will. So until we have to do that, which would be this next game, I'm hoping we get decent teammates, man. I don't like ending the day. I want to improve, right? The name of the game is to improve, for me at least. Speaking of improvements, I bought a Blue Eyes White Dragon, a little collectible today. The same way I would when I was a kid, but instead of, my family buying it for me, I bought it for me. It's, it's $2-3, but I think this is probably emotionally worth millions. I mean, this is emotionally worth millions to me, It's so cool. It's such a cool little action figure. I'm all about it. All right, final game, LG, last game. They're not going to want to go there because they're going to have to wait for the bus to get there. And this generation, nobody waits for anything. Look at that, he's willing to wait. We've got action like a motherfucker, man. Revert team, get over here. Come this way, don't go that way. They've got better guns. probably. Right? Yeah, they probably got better guns, man. Ah, no. Damn, I don't want to do that. Oh, no, dude. I could have sworn I hit that shot, I'm not gonna lie. I thought that first shotgun shot was... Alright, you know what, that's my fault. Ah, that was such a hot drop. I just don't want to end my night this way, you know. Let's give it another... Let's give this the good hearty try, right? I'm gonna go quads, hopefully more people. The theory behind playing duos, trios, quads, there's gonna be some people out there who are just better than you and willing to carry you. And carrying me, number one, I can be bad. Number two, when I watch this back, I can learn from them, right? And I really want to do that because my skills, you know, they got a little bit of a ways to go. What's that? And then we'll end this because it's been, what, 4 hours? Oh, 3:40. It's actually better than I thought. That was a bit of a meaty chapter. Meaty chapter. And it's recording now. So 4 hours, it's going to be 5:30. Go out, get a snack. You know, get some fresh air, look at the light. Yeah, baby. If you recommend vibrations, you know, let me know what y'all got. I like these, man. Shut the fuck up. I don't care about what it is you're selling me. Fuck you, Kleenex. I'm just gonna buy the generic brand just to give him a middle finger. Alright, LG, it's the last game so long as it's a decent game. I don't need to be perfect, but I need to be decent. What's this? The legendary outlaw key card. Lock it up, lock it in. Where are we heading? We need places we can hide. Oh, I love this place. The fields out in nature. Out with your roots. Team's landing on outskirts. I mean, as long as we scatter around, I think we're okay. Alright, they can see my back, I can see theirs. But I gotta grab these guns. No. I'll just grab them. Quit playing with these kids, man. Where we at? Ooh. Oh yeah, I see him. He sees me. I know he sees me. Yeah, he's stupid. Play the tractor. I lost that. Cannot believe I lost that. I can believe it, but part of me just wishes I had infinite ammo, you know? Oh, team, you don't gotta come and get me, man. No, you don't gotta come and get me. Ugh. Could it be that I'm just checked out? My strategy's not as crisp. Those are some of the most beautiful shots I've ever seen. Use your cover, use your cover, use your cover. Oh no. Yeah. I'm not ending the night this way, I'm not. Oh, no chance. How do I, You know, there are some times where you got to use your brain and realize certain situations they're not meant for you to have faith in. This was one of them. Do I think he'll pull it off? I think he'll pull it off. Never mind. Who are these bots? How did he get this gun so... Oh wait, we landed at a black market. What the hell am I talking about? No, 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 no. Okay, yeah. Wow. Okay. I'm eating my words. To right, to right, to right. You see him. Get yourself some loot. You're dead. To your left. Oh. Why did you pull her? To your left. What are you doing? Dead. Dude's getting an angle. You're choosing to watch. To your left. Again, not ending the day like that. You wanna go downstairs and watch cartoons, bud? I'll be right there. Take your blinky. Or you wanna hang out with your brother? Oh, you're gonna hang out with your brother? You wanna stay here?
Yes.
Okay, alright. Whatever you say. How are you?
Good.
I love your hair. Oh, you going back to CP?
Yes.
The power of nap time, huh? The powers of nap time? Yes. Is that how you say it? Did I say it right? Yes. What about Squidward? Hi, how are you? Okay, see you around. Wonderful weather we're having. From now on, I'm normal. Normal, huh? Yep. Oh, really? Yep. Whatever. Back to the scene of the crime. Oh, I got gold. I can play this last one. What the f... I wonder if this is the strat for sweaty lobbies, right? Just go somewhere you know nowhere no one is, so that at least you can get some, you know, livable loot, decent loot. Get me the heck in here. What the hell's going on? I don't hate that gun. I don't hate this one either. Yeah, I gotta... Damn. I'd rather have these. Those are my fights, man. Those are my fights. That's where I'm prime time. Just at a very good clip, you know. Things are firing, things are moving well. Just looking for ammo here. Players. are just bots. Did you piss off? Is this a motorcycleta? Let's go, fellas. Let's go. Let's go. Let's go. Let's go. Ooh, 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 ooh. Good call, teammate. Yeah, you're right. We were kind of pinched, didn't have anything. My mistake. Don't you dare splash those on you without me there. You bastard. Splash. There we go. I'm gonna hold it. I'm gonna hold it. Just the style on him. I'm gonna hold it. think I will. It's good for getting away, I'll give it that. Why did I do that? I'm on 7-2. You know what? No. Compared to the other games, this has been really good. Compared to the other games, this is really good. I can live with this. I can work with this. Alright, that's going to be EOD, end of the day for me.